Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RTX.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're looking at RTX Corporation today, a huge aerospace and defense company. They just posted their Q3 2025 results, and honestly, the fundamental picture is looking extremely bullish.
And that execution really seems to be the core story, isn't it?
It absolutely is.
Yeah.
Q3 sales, they came in at $22.5 billion. That's a 12% jump year over year.
12%. And how much of that was, just their core business?
That's the impressive part. 13% was organic growth.
Yeah.
So they're driving momentum from their main operations, not just buying up other companies.
And you can see that operational leverage really kicking in.
Exactly. Look at the bottom line. Net income. It jumped a very strong 30%.
Wow. So they aren't just selling more, they're making more on each sale.
Precisely. They're managing costs better. They're more profitable. It's really the sign of a well-run industrial company.
I think the market really got excited when management updated their outlook. They didn't just meet expectations, did they?
No, they raised the bar significantly. The new adjusted sales outlook for the full year 2025 is now $86.5 to $87 billion.
And the earnings followed suit, I imagine.
They did. Adjusted EPS guidance is now up to $6.10 to $6.20.
That upward revision, it signals a lot of confidence from management, right? It's not just a one-quarter fluke.
It tells you they believe the efficiencies and the contracts are structurally sound.
Let's turn to the balance sheet for a second, because that's where the real long-term strength is.
It is. They generated $4 billion in free cash flow in Q3 alone.
Just in one quarter. And the full year guide.
They're guiding for $7 to $7.5 billion for the full year 2025. I mean, that kind of cash generation gives them so much optionality.
And they put it to work. They paid down almost $3 billion in debt.
Right, a substantial amount, while still giving $900 million back to shareholders through dividends and buybacks.
Okay, but let me just push back on that for a second. With the stock where it is, and interest rates may be easing up.
Yeah.
Should they have been more aggressive on the buybacks? I mean, is paying down debt the absolute best use of capital right now?
That is a very fair challenge, and, a lot of people are asking that. But for a business like this, with these long cycles in aerospace and defense, a healthy balance sheet is everything.
So it's about stability.
It's about stability. Reducing that legacy debt gives them more flexibility for, say, a huge future investment or an acquisition. They struck a good balance, I think. Prudent management.
Prudence is definitely baked into their whole structure. I mean, RTX isn't just one business, right?
No, it's a trio of powerhouses. It gives them this huge economic moat that's hard to compete with.
You got Collins Aerospace, Pratt & Whitney, and Raytheon.
Exactly. Collins does commercial aircraft components, Pratt & Whitney is the jet engines, and Raytheon handles all the advanced defense and missile systems. It's incredibly diversified.
So if one sector slows down, the others can pick up the slack.
That's the idea. And the proof is really in one staggering number.
The backlog.
The record total backlog of $251 billion.
It's a number that's so big, it's almost meaningless. How do we even put that into context for an investor?
Well, think of it this way. At their current rate, that's about 4.5 years of revenue already locked in.
4.5 years of certainty.
Multi-year certainty. Very few companies have that. And it's split. $148 billion in commercial aerospace and $103 billion in defense. So you see that balance again.
And it's not just locking in revenue, right? We're seeing margins improve.
Consistent margin expansion across all three segments. It shows that their cost management, their productivity initiatives, they're working. They're turning that top-line growth right into bottom-line profit.
Okay, so the fundamentals are incredibly strong. We've got clear structural tailwinds.
Yeah.
So why isn't the stock at $200 already? What are the technicals telling us?
Well, technically, the stock is in a confirmed uptrend, which is good. It lines up with the fundamentals. It's trading above its 50-day moving average, around 172.
And the 200-day?
Much lower.
Okay.
Down in the 145 to 149 range. So the bulls are definitely in control of the trend.
And right now, as of mid-November, it's trading near, what, 175.50?
Yeah, around there. And we've identified this short-term resistance barrier. It's between 180 and 185. The market seems to be taking a little breather after that big Q3 rally.
So that 185 mark is the key level to watch.
It's crucial. A breakout above 185, especially on high volume, would be a major momentum trigger. You'd likely see a wave of new buyers come in.
What are the indicators saying about short-term momentum?
Well, something like the Stochastic RSI is reading at about 15.7. That suggests it's recently been a bit oversold, technically.
Which could be a good entry point for bulls.
It often is. It means the short-term selling pressure might be easing up, maybe giving investors a chance to get in before the next leg up.
And sentiment seems to back that up.
It does. Retail investors are energized, and institutionally, we've seen more money flowing in since the earnings report. So the big money is buying into this story.
What about the analysts? What's the consensus there?
The consensus is pretty confident. 13 analysts rate it a buy. The average 12-month price target is right around 175, where it is now.
But the high target?
The high target goes all the way up to $215. So the upside potential is clearly there if they keep executing.
Okay, so let's talk about the catalysts. The stock jumped 5, almost 9% after earnings in October. But what are they doing right now to drive future growth?
They're making some very strategic moves. Pratt & Whitney just opened a new technology and innovation center in the Netherlands. This is all about securing their long-term advantage in engine components.
And on the defense side?
Raytheon signed a deal with Avio to build a new solid rocket motor facility in the U.S.
That feels strategically important with the push for domestic supply chains.
Hugely important. It helps them secure those ongoing government contracts.
Looking ahead, what's the next big date for investors to circle on their calendars?
Late January 2026. That's when the Q4 earnings report is due.
And another beat there could be the fuel to push through that 185 resistance level.
Without a doubt. And beyond the numbers, we're just watching the contract flow. They booked $37 billion in new orders in Q3. We expect more major announcements before the end of the year.
And with all that free cash flow, there's always the chance for, a bigger buyback or dividend hike?
Exactly. Management could announce something like that to act as another catalyst heading into 2026.
There are also these, I guess you'd call them whispers, about a really big international contract, something with NATO or in the Middle East.
Yeah, those rumors are floating around. Unconfirmed, of course, but if a headline like that were to drop, it would be an immediate and massive catalyst for the stock.
Okay, so before we wrap this up, we have to talk about the risks. As good as this story is, what could derail it?
Well, you have your general risks, execution on big programs, supply chain issues. Every industrial company faces those.
But what about risks specific to RTX?
The big one, the one everyone is watching, is the ongoing inspection issue with the geared turbofan, or GTF, engines at Pratt & Whitney.
Right, that's been a known headwind.
It is. It's a quality issue that requires these extensive inspections, and that means costs and delays for their airline customers. It's a financial risk, but it's also a reputational one.
So even with a story this strong, that remains a real operational issue they have to manage perfectly.
They do. They've done a good job quantifying the financial hit, but the risk of managing that fleet on the ground is still very real.
So with that engine issue in mind, how much of a buffer is that $251 billion backlog, really?
It's the ultimate strategic buffer. I mean, yes, a big market shock can hit any stock. But those massive multi-year defense contracts provide a level of predictability that just insulates them from a lot of the short-term volatility you see elsewhere.
So let's pull it all together then. What's the final thesis here?
I think the alignment is just. It's incredibly compelling. You have superior fundamentals from Q3, you have management reason guidance, and you have bullish technicals and sentiment all pointing in the same direction.
It seems like it has appeal for different types of investors, too.
It really does. For short-term traders, you've got the Q4 earnings and potential contract news coming up. But for long-term investors, this is just a prime structural growth story in critical global sectors, backed by nearly 5 years of guaranteed revenue.
If RTX manages to successfully mitigate the GTF engine risks while securing one of those large rumored international defense contracts, that $251 billion backlog could look even more conservative very quickly.